Okay, so we're typical pre-seed round sizes in health tech. Question for Puneet. So I'll talk about pre-seed in general, and then I'll talk about the exceptions. So the pre-seeds in general is a team. Let's say it's a first-time founding team. You're coming with a deck. Maybe you launched, maybe you didn't, but it's usually better if you've launched with no traction. You want to typically raise these days 500K to a million, and the pre-money valuations have been 3 to 5 million. It's inching up a little bit. Now, if you're a second time founding team, you may actually skip that stage altogether, and your pre-seed round might look like your seed round. And frankly, if you're an extraordinary team, your first round might look like a B or an A, and especially in frothy markets like we're seeing today. I mean, a founder who's been 3 times successful and has had multi-billion-dollar outcomes, the next time they go out, they might raise 20 at 100 to get going. But that's the exception, not the norm. The norm at the pre-seed remains you're raising a million at 5 pre. And it was 3, now it's more 5. But it's kind of there. Now, the exceptions or the caveats is one of the categories you're talking about, like healthcare, right? If you're in biotech or if you're in clean tech, where the capital requirements are higher, you actually see bigger seed rounds, or pre-seed rounds, and often you see actually more of the bigger seeds and A's. I mean, we're investors in a company called Artemis. It's a lab-grown meat company, and the seed round kind of looked like a normal seed round, but now they're going for an A, and I think their A is like 20 million or something like that, which because it is highly capital intensive, but that is the norm in that category. I don't know if Kelly have any or
Yeah. No, I think that's right. I think it depends on the capital requirements. We also see it in real estate, right? You're more, maybe you'd raise 2 to 3 million because you can't raise debt so early, and so you're buying properties, or there's some reason that you need to fund growth on equity, which is a really expensive way to fuel traction and to launch. But it's often the only option when you're so early, given that debt is a more risk sensitive
oh,
vehicle.
so Hale actually clarified is how do you talk about market adoption? Actually, the it can be part of the story because imagine you're in an offline business that is, where all the transactions have been done offline, but it's a large category and now no one's online. Your pitch is we're going to bring them online, and so that could be totally be part of the pitch. I mean, think of Tool BX as like people are doing procurement through by calling up and asking for suppliers to deliver stuff. Adopting technology will convert it. So absolutely, the adoption should be in the deck. I mean, imagine you're in a food delivery business today, and I don't know what percentage of food is food delivery today. I'd say 5%. There's a very compelling case for why it should go to 50%. Even though you might be very large, you can make a case you're going to be a lot larger. So adoption should definitely be part of it.
Yeah, I think those generally come into play if you want to talk about fill rate, if you want to talk about repeat rate. Those are good ways to impress the idea that there's adoption going on.